want to bring on our next guest for more reaction to the release of the Fed minutes. Let's go to Ethan Harris. He's head of Developed Markets Economics Research at Bank of America Merrill Lynch, and he is a Bloomberg Best forecaster. He joins us from his firm here in New York. Ethan, welcome back to Bloomberg's Bottom Line. Always good to have you on.
Thank you.
Ethan, our Michael McKee just broke down the Fed minutes. Anything surprise you?
No, I think that the contentious meeting makes sense. I mean, the QE2 wasn't exactly a policy that everyone felt really good about. And as the economy picks up, of course, you're getting members of the committee who are wondering, did we really need to do this? And the discussion they have about whether spare capacity drives inflation or not mimics the economics profession. There's quite a debate over whether we can really rely just on spare capacity or do we need to look at other factors. So I'm not surprised that it's a pretty contentious meeting.
Where do you come down, Ethan, on that growth gap versus output gap debate?
I think that the spare capacity argument, at least at this stage of the business cycle, is compelling. We're talking about big gaps. We're talking about an unemployment rate of 9% when normal unemployment would be 6 or 7. We're talking about lots of vacancies in the housing market, particularly in the single-family market. We're talking about empty factories. There's a lot of spare capacity right now. Now, that will be offset by some global forces driving inflation. But I think that the majority of the committee is right, that while inflation may not drop much further, it's probably going to stay low for an indefinite period of time.
Ethan, at least from the perspective that Michael was telling us and what the Fed was saying about quantitative easing, is it a stretch to say that the Fed still does have its foot on the accelerator and that it could take it off anytime it wants to?
Yeah, I think that I don't think QE2 has done much, to tell you the truth. I think it gave a little bit of rally in the markets that then reversed. It hasn't really created inflation pressure. I know there are a lot of people out there trying to blame QE2 for every price in the world, but QE2 didn't create floods in Australia or droughts in Russia, nor did it create strong food demand in Asia. There's just a lot too much credit and blame given to QE2. Yeah. The reality is that the Fed right now pretty much has its fingers crossed in getting growth, continued growth that heals the economy.
But you say that QE2 hasn't really done much for the economy, but it hasn't spurred inflation either, has it?
No, and that's the point, is that a lot of the argument over QE2 I thought was overdone. It's really a small policy change in a world where we've seen a lot of very radical stuff go on. It was the Fed's attempt to give a little extra nudge to the economy. I think it was better that they did it than that they didn't do it, in the sense that it probably did help the stock market reignite. But I don't think it's solving any problem for the economy, nor do I think it's creating serious problems. I think it's a small positive nudge to the economy.
I assume you're going to come down on the side of those who say that there may not be time to stop QE2 before they get through with the purchases. If that's true, then when do we see the first sign that they are beginning to reverse course?
Well, I mean, there are a lot of people talking about the Fed perhaps hiking interest rates by the end of this year, but that would be quite a quick change of course. The Fed's very likely to continue their buying program through June, then go on hold for a long period of time, then announce that they're ending their extended period, that they're thinking about an eventual rate hike, then they will hike interest rates. And so that turning of the ship probably doesn't happen until well into next year. So I think the talk about the Fed going at year end is another example, which we've seen many examples of in the last 2 years, of the market starting to pull the Fed forward too far. The Fed still has a ways to go here.
Could that happen once they say we're ending the extended period? Do we see a big market reaction as people reprice? And so it doesn't really matter whether the Fed formally hikes rates or not.
That could be a big moment. That's why they have to be very careful about when they start the serious exit. When they announce we no longer have an extended period, we could get a significant shock to the bond market and the stock market. That's one of the reasons I don't think they announce it soon. I think they want to see more healing in the economy, more improvement in housing, banking, state and local government, all the sectors of the economy that have been wounded. They want to see real healing. Then they'll come out and say, you know what, maybe we got to think about raising interest rates.
Yeah, Ethan, some other economics news today. Producer prices increasing 0.8% last month. We saw increase due in large measure. There was a jump in gas prices about 7%, but food prices up nominally about 0.3%. What should consumers take away from this?
Well, there's a lot of commodity pressure in the system, and it looks like some of it is bleeding through the pipeline and will eventually land at the consumer's door. The PPI, of course, is the producer price, so it's not a consumer price index, and there tends to be a big slippage between those two series. But I wouldn't be surprised if there's a little bit of upward pressure that finally makes it through the consumer. It really hasn't happened outside of gasoline so far. Yeah. But we think there'll be a little bit of pressure that makes it to the consumer.
Ethan, we also saw that housing starts are rising at the fastest pace in 20 months. The increase was about 14%. But then the pace of construction, that was still at a seasonally adjusted 596,000, well below what economists say is necessary, about 1 million units. Does this go back to jobs and the credit market?
Well, I mean, normally the housing market leads economic recoveries. You have an absolute explosion in housing activity as the Fed lowers interest rates and everyone goes out and gets a mortgage. Obviously, this market is very different, and the real recovery won't happen until the foreclosure process plays out. I think that this report, if you look under the surface, simply confirms we've got a very weak housing market. You had a lot of apartment construction that started in January, but if you look at the single-family market, where most of the distress is right now, the data remain extremely weak. I don't see a real recovery in the housing market for another 2 years. And I think this report confirms that.
All right, Ethan Harris, Bank of America Merrill Lynch, joining us, and our economics editor Michael McKee as well. Thank you both very much.